All attendees are in listen-only mode.
Hi there, and welcome to today's episode. Today we're going to be speaking about how to understand your profit and loss sheet. So this is in a series of finances and understanding your major business financial components of any business, really. And what I've done with with this recording is want to speak to you today about how to understand the profit and loss. Now, this once again is in a series. So there's other series under finances that you're able to watch. As the business owner and being here, you're able to get 4 or 5 of the most important financial, I suppose, sheets and or statements that you need to really understand to make sure that you run your business successfully and have no problem on the way through. Now remember that the figures don't lie. So having that and having these 4 or 5 major components and or major financial statements that you need to know. I believe that you can then run a successful business just by knowing it. You don't have to be an accountant, but you just got to know enough to make sure that you understand the numbers and what it can do with your business. All right, so let's get on the way. Okay, so today we're going to be speaking about profit and loss and how to understand a profit and loss sheet. Now, I've created a summary here to give you a little bit of an explanation, into layman terms so everybody can understand. I like things that are just said simply to me so I can understand. I've got no doubt that you're the same. So I believe this: the profit and loss statement is a summary of the financial performance of a business over time. So monthly, quarterly, or annually, is most common. It reflects the past performance of the business and is the report most often used by small business owners to track how their business is performing. Now, as the name indicates, the profit and loss statement, also known as a statement of financial performance or an income statement, measures the profit or loss of a business over a specified period. A profit and loss statement summarizes the income for a period and subtracts the expenses incurred for the same period to calculate the profits or loss for that business. Now, this profit and loss statement is also what's called a lagging indicator. Now, what does a lagging indicator mean? It means that it's telling you what's happened in the past. So usually it's telling you what's happened the month before, as an example. So if you're reading this and it's May, usually it'll tell you what's happened in April, right? So whatever you've done there has led to the profit and loss statement today. So it's a lagging indicator and it's past performance of the business. And it just gives you a really quick snapshot of what's going on by showing you the profits and or the losses of that business. It's not always profits. Sometimes it's losses. Hopefully we're going to keep away from the losses and work towards a profit. Okay, so let's sort of calculate this and go through this together. So what I've done is I've just put an example together for you to be able to see it. Now, let's say that your revenue and income from sales was about $500,000 for the month. You're a reasonably established business. You've got a pretty high-end product that you may be selling, or an intermediate product that you're selling, and it's $500,000. I mean, some businesses it's more, some businesses less. Just go along for the ride, and then you can put your figures into here as well. Now, I'm going to take away the cost of goods sold. So this is minus $250,000. So I've made $500,000 in revenue or income generated from sales. It's 500. I take away the cost of goods. So this is what I had to, buy the product with that I was selling. That's 250. So it's left me with a gross profit, or a GP. Often you'll see it as GP, gross profit. That's before tax or any other expenses that I have, for $250,000. Yep. So it's 500 minus the 250 equals $250,000. Now, let's say your fixed expenses are $200,000. So what do I mean by fixed expenses? In the fixed expenses, what we're looking doing, what fixed expenses are, is everything that is going to be an expense that usually happens over and over again within a week or a monthly or a quarterly or yearly period. As an example, one of them may be your rent. right? So as a business owner, if you're renting a premises, usually you're in for 12 months, 2 years, 3 years in a lease, and usually that expense is pretty much going to be the same every month. So that's a fixed expense. Now another fixed expense may be, as an example, your telephone bill, or your if you've got a lease on some equipment like a printer or a computer, or lease on factory equipment, or a lease on a vehicle that you may use. So usually they're fixed expenses every month, the same expenses in and out. Now wages also may be that, especially if you've got people that are on a salary, so they're on 50,000, 80,000, 100,000 a year, whatever it may be. That's usually a fixed expense. Now you've also got a variable expense in that. So a variable expense is when you've got something like, as an example, a registration on the car. Now that could be technically a fixed expense, but you're not doing that every month unless you divide it by 12 months. So maybe that particular month you've got a variable expense of $1,000 to get your pink slip, your green slip, and then pay the registration on your car for that particular month. That goes over the whole year. Now, another thing could be maybe you've had a bit of a breakdown on some of the equipment that you've had, so you need to fix that. So that may be a variable expense that you weren't expecting, or maybe you're employing some part-time staff members that can help you in the busy period, the Christmas rush. Maybe you've got a sale, stock take, whatever it may be. So think of it like that. So that's a variable expense that sometimes is also added to the fixed expenses. So you've got fixed expenses plus variable expenses. Now that means that you've got a profit or a net profit, EBIT, earnings before income tax, of about $50,000. So let me show you the mathematics. $500,000 in income and revenue generated from sales. 250,000. It could be not only just sales. It could be, it could be, you've got a property that you're getting rent for it. But let's call this sales just for education purposes. So 500 minus the 250 gives you a gross profit. This is a gross profit without any expenses yet of 250,000 minus 200,000 gives you a net profit, earnings before income tax, of about $50,000. So, or in this case, as an example, if this is 100%, if you didn't have any of these expenses here, you'd make that 100%, which would be great. But roughly, this particular exercise or example is running roughly at about 10% net, or just before income tax. Yep, 550 grand, about 10%. Okay, now let me show you an example of a profit and loss statement. So see, total revenue, $1 million as an example. Let's call this. This could be, over the year, right? Profit and loss over the year. That's 100%. Cost of goods sold is 426. That's about 42% of this million. So the gross profit says it's about 57.4%, or $573,800 gross profit. So I've gone that minus that equals this. Now, your expenses, then you can see all the expenses. So things like wages and salary, vehicle costs, rent for premises, memberships, repairs and maintenance, interest or bank charges, insurance. See, there's all of these things that you got to make sure that you're looking at. And a lot of these are fixed expenses. Now, maybe all other expenses, this may be a variable, as an example, right? So you've got 1 million less the cost of goods, less the expenses, less the total expenses. That's 488,000, right? So if I add all of these up, right, it's 488. So I go that minus that, roughly gives me $85,500. So I want you to think about it, that it's 100% here. I'm adding all of these together, the 42 and the 48. Right, and roughly I've got 8.6% in equal, see, net profit, BOS, or before owner salary. So in other words, in these wages and salaries, the owner hasn't taken any money in, which is very, very common in small business owners. Now, I believe that you want to get it to the point where you're adding your salary into here and you're taking that as an expense, and your salary is added here. So then we can get, instead of net profit BOS, we get net profit, EBIT, earnings before income tax, like I showed you on the previous slide. So roughly, this business is running at 1 million, and it's about 8.6%. So it's reasonably low, especially because there hasn't been any income in here. Because why? Cost of goods is it's high, 42%, and then all the expenses that you have, if you had to add all of these together, comes to fair margin there. Yep. So 573 minus the 488,300 leaves you about $85,500 or 8.6%. All right, now I've given you a little bit of a breakdown on what I believe as a business owner you should take into consideration. Number one, are your expenses too high? You want to ask yourself, are your expenses too high? In this case, they were pretty high, $480,000 just in expenses. So high labor costs, and that could definitely affect the business itself. Are you doing enough sales? I mean, this is very important. A lot of business owners, the reason why the profit and loss is usually in the loss is because it's not looking too good, and they're not making enough sales. So usually that's not a good sign, because they're on a negative. Now, by the way, let me just go back here for a second. If this figure here if this figure here had a bracket on it, let's say the expenses were 300,000 and the gross profit were 250, then the fixed expenses were 300. Usually you have a bracket on here and possibly a little minus, and usually it changes color into red depending on what software you're using. And the brackets though show that that's a minus, so that means that it's a loss, not a profit. Yeah. So once again, with here, if this had a bracket on it because the expenses were dearer than the gross profit, that'd be a loss. And usually it's got a minus here that says we're minus 10%, and that's what you don't want to do, because sooner or later you're not going to be in good shape as a business owner. So are you doing enough sale? Another cost of goods too high. This could be a possibility that your cost of goods are really, really high. 42%, 50% almost is reasonably high. So you want to make sure that that could be down. And the next question here is stock levels being managed? And here's what I mean by that. Have you purchased a lot of stock? So the cost of goods, purchased, and you got a lot of it, you're holding on to it, and you're not really moving it. I mean, my belief there is that if you've got stock for longer than 90 to 120 days, you want to start looking at moving that stock, because it's depreciating too much in value, especially if it's something that's a perishable. You want to make sure that isn't happening for you. So you want to make sure that you're moving that stock along. Now, in saying that, you may drop the cost down pretty radically and maybe make only 5% margin and or break even, sell it for cost, or sometimes it's a little bit of a loss, and then you can recoup it on the next one. But you need to really ask yourself, is your stock level being managed? Also, are you ensuring that your tax contributions are also being calculated? Inside there, you must have a tax contribution that you need to give the tax department, because, hey, guess what? That's not your money. Now, if it's GST alone, there's 10% on the earnings minus any of the costing. You have to GST collected versus GST spent. You need to give that to the government, right? That's not your money. You need to give that to the tax department. So you want to make sure that you're calculating that, especially inside your profit and loss, so you can make sure that that's accounted for and you're good to go. And the last one is, can you reduce your overheads in any way? Because the overheads, especially the fixed costs on things like rent or lease equipment or any of that stuff, it just never stops. So for a business owner, if they have a bit of a bad month or a bad quarter, that's one of the things that they really need to look at to see if they can, drop that down as much as they possibly can. So you might want to see if you can maybe move in with somebody else, share the factory space if that's what it is. Maybe work out of a shared space. If you've got an office that is costing you a lot because maybe you haven't got enough staff to be in there, or maybe you bought the offices too big, or whatever it may be, how can you reduce your overheads? Do you need as many employees as you have? Can you possibly drop that down any further? I like to say, the leaner the ship, the better it is, okay? So you need to make sure that you're in profit, not in loss, because most small businesses cannot sustain loss after loss after loss. Okay, I hope you really enjoyed it. Enjoyed this episode. Remember, it's a part of other episodes that are within the finance component of this membership platform. So I look forward to sharing some more information with you. And until then, have an incredible day.